Smart ways to manage entries, not just guessing. Hello everyone. Welcome back to Mr. So Crypto's channel, where we discuss the world of crypto in a sensible, fun, and grounded way. In this episode, we'll discuss one strategy that can help you not only survive in a volatile market, but also have the opportunity to take more profitable positions. Multiple entry strategy. If you've been feeling like you're always entering at the wrong time, buying when the market is about to drop or selling when it's about to rise, this strategy is perfect for you. Because in the market, it's not just about buying at the lowest price or selling at the highest price. What's more important is how we manage risk and make smart entry decisions. If you've been thinking that entries must be made all at once, like going all in when prices are dropping, then get ready for an emotional roller coaster with no clear direction. In the crypto world, especially in a market phase filled with speculation like now, a one-time entry strategy can feel like gambling. And remember, we're not gamblers here. We're investors and traders who use data, logic, and strategy. This multiple entry strategy can be a lifesaver. Because when you divide your capital allocation into multiple entries, you're actually reducing the risk of poor timing and increasing the chances of getting a more favorable average price. This isn't empty theory. It's how portfolio management works, used by large investors as well. But of course, multiple entry isn't just about buying in installments as long as it's cheap. There's a method to it. There's a way of thinking behind it. And that's what we'll cover in detail today, from how to read the market from the bigger picture to practical ways to determine ideal entry points. So, before we begin, make sure to sit back, grab a cup of coffee or tea, and stay tuned until the end. Because this strategy could be a crucial foundation for your investment journey in the crypto world, especially if you're into altcoins, staking, or Layer 2. Ready? Let's dive into Chapter 1. Why we must look at the bigger picture before entering the market. Let's go. Chapter 1. Always use a large time frame to see the bigger picture. Okay, imagine this. You want to travel from Jakarta to Bali, but you're only looking at Google Maps at the highest zoom level. You're only focused on the streets or alleys where you're currently standing. You don't know which toll roads are clear, you don't know what the weather is like in Surabaya, and you also don't see any volcanoes erupting along your route. Do you think you'll make it? Well, that's roughly what happens when you make entry decisions based solely on small time frames. Small time frames are often filled with noise or signal interference. Rapid price movements on 5-minute, 15-minute, or even 1-hour charts often don't reflect the overall market direction, especially if you're looking at the chart and suddenly feel FOMO because a long green candle appears on the 15-minute chart. Hold on. The psychology behind small time frames. Small time frames are extremely dangerous for your mental state. Seriously. Why? Because every small movement can trigger your emotions. See a slight price drop, and you panic. See a green candle, and you feel FOMO. See a sideways chart for 3 hours, and you get bored and end up opening a random position just to get some action. And that's a classic trap. The market is designed to drain the mental resilience of impatient people. If you look at larger time frames like daily, 1D, weekly, 1W, or even monthly, 1M, you'll see something that's not visible in smaller time frames. Market structure. Market structure exists in larger time frames. With larger time frames, you can identify important things like long-term trend. Is the price in an uptrend, downtrend, or sideways? Historical support and resistance areas. Where does the price often bounce? Where has the price failed to break through? Major patterns, such as double tops, inverse head and shoulders, falling wedges, etc. These are often not visible on 15-minute or 1-hour charts. For example, if you look at Bitcoin on the daily chart, you can see that the price is still within the post-halving accumulation zone. But if you only look at the 5-minute chart, you'll see BTC as chaotic, moving up and down unpredictably. In reality, on the bigger picture, it might be consolidating before a breakout. Large time frames as a guide for multiple entries. Here's the key. Multiple entries don't mean entering randomly multiple times, but entering with a strategy based on big data. By using the larger time frame as a guide, you can start determining at what price zone you will make your first entry, where the historical support levels are that could serve as the second entry point, where there is a correction within the uptrend, healthy pullback, suitable for the third entry, and so on. Imagine you enter 4 times, and you already know the price is still above the long-term support level. The overall trend is still bullish. Volume is still strong and rising. This means you can start scaling in, entering gradually in safe zones based on logic, not emotions. Small time frames are still okay, but this doesn't mean small time frames aren't important. They're very useful for fine-tuning. For example, if you know you want to enter at the weekly support zone, you can use the 1H time frame to see if there's a bullish divergence or increasing volume. But remember, small time frames are only for confirmation, not the primary basis for decision-making. Realistic analogy: farmers and planting seasons. Using a large time frame is like a farmer who understands the seasons. They know the best time to plant and when to harvest. Meanwhile, traders who only use small time frames are like people who check the weather through the window every day but don't know what season it is. So, if you want to plant seeds, make sure you understand the larger season, the bigger trend. Don't just rely on a passing shower. Conclusion of Chapter 1. Larger time frames give you the right perspective on market direction. Avoid making major decisions based on 5 to 15-minute charts. Use larger time frames to determine entry areas, and smaller time frames only for additional technical execution. The bigger the picture, the better your judgment. Alright, that's it for Chapter 1. How about it? Starting to see the bigger picture. If you feel like you've been too focused on the 1-hour chart and often regret your entries, maybe it's time to level up. Let's move on to Chapter 2. Identifying support with psychological numbers. Because it turns out the market also has favorite numbers that are often used as bounce points. We'll explore this together in the next section. Chapter 2. Identifying support with psychological numbers. Because the market also has preferences. If you've been in the world of trading or investing for long enough, you've probably experienced moments like this. Bitcoin price drops to $60,000 and then bounces back. Ethereum hits $2,000 and then buying volume comes in. An altcoin drops to 10 cents, then immediately rises 15% in a single day. Coincidence? No. That's what we call psychological levels. Round price levels that are mentally easier for humans to process and often become the gathering point for traders and investors to enter or exit the market. Why are psychological levels so powerful? The reason is simple. The human brain prefers what's easy to process. Instead of saying, I want to buy BTC at $58,974, most people would say, I'll wait for BTC to drop to $60,000. Now, if millions of people think the same way, that means there will be a lot of orders around that price, and boom, it becomes a natural support area. These psychological numbers have collective power. The larger the market cap of an asset, the stronger the effect of these round numbers because of the volume of transactions accumulated there. Even large institutions sometimes play around with these numbers, especially when they're creating a strategy to enter with large volumes but don't want to be seen. Classic examples of psychological numbers. BTC, $70,000, $65,000, $60,000, $50,000, $40,000, $30,000. F, for $1,000, $3,000, $2,000, $1,500. Altcoins, $1, 50 cents, 10 cents, 5 cents. Microcap tokens, 1 cent, $0.005, $0.0001. If you open the order book on a major exchange, you'll see buy and sell orders often pile up at these levels. This isn't magic. It's the reality of crowd psychology in the market. How to use psychological numbers in multiple entry. Now, how do we implement this in a multiple entry strategy? 1. Build a grid entry based on psychological numbers. Example, you want to enter an altcoin that is currently priced at $0.145. You've checked the market structure on a larger time frame and know that this price is in a healthy downtrend or correction. You can create a grid entry like this. Entry 1, 13 cents. Entry 2, 10 cents, psychological number. Entry 3, 8 cents. Entry 4, 5 cents, strong psychological number for altcoins. This way, you have a stable average price, and you also give the market room to correct further without panicking prematurely. 2. Combine with historical support. Psychological numbers will be stronger if they coincide with past demand areas, MA 200/EMA 200 zones on large time frames, high volume profile areas. For example, You see that ETH has bounced off $1,500 three times in the last year. What does this mean? It's not just a round number, but also historical support. This double support is ideal for entry. 3. Use alerts, not feelings. Don't wait until you feel confident. Use alerts. Set alerts at the psychological levels you've marked so you don't FOMO when the price hasn't reached there yet, and don't panic when it suddenly drops there. Disciplined trading equals winning trading in the long run. Real case. Entry in the middle of a bear market. During the 2022 to 2023 bear market, many smart investors began accumulating Bitcoin around $16,000 to $20,000. Why? Because $20,000 was the previous ADH, 2017. $18,000 was the weekly support level. $15,000 is a psychological round number plus retail panic level. They entered gradually, not all in at once. And the result? When BTC rose to $40,000 to $60,000, they just sat back and counted their profits. Pro tip, don't get trapped by every round number equals entry. Not all round numbers are good. Sometimes prices keep breaking through those numbers because they haven't found a strong structure yet. Use psychological numbers as a reference, not the only indicator. Combine them with volume, technical indicators, or on-chain indicators for validation. Chapter 2 Conclusion. The market tends to bounce off round numbers due to mass psychology. Use those numbers to build a reasonable entry grid. Combine with historical support, not just enter because it looks cheap. Be disciplined and set alerts. Don't enter based on feelings. Alright, that was Chapter 2. It's becoming clearer that multiple entries aren't just about buying in stages, but buying intelligently, based on market patterns and habits. Next, we'll discuss how technical indicators and on-chain indicators can help us determine when the market is oversold and undervalued. Stay tuned. We'll move directly to Chapter 3, Leveraging Technical and On-Chain Indicators. Chapter 3. Utilize technical indicators. Don't just guess the market. In the highly volatile world of crypto, we need tools to assess whether an asset is overvalued, too expensive, or undervalued, on sale. This is where technical indicators and on-chain indicators come into play. If a multiple entry strategy is like putting together a puzzle, then indicators are the spotlight, so you know which pieces to place first. What are technical indicators? Technical indicators are visual tools created from price, volume, and time data. Their purpose? Not to predict the future, but to help you see probabilities based on previous market behavior. Examples of indicators commonly used for strategic entries. RSI, Relative Strength Index. MACD, Moving Average Convergence Divergence. Stochastic Oscillator. Bollinger Bands. Moving Average, MA/EMA. Magnifying glass tiltedrite focus on oscillator indicators. Look for oversold areas. For multiple entries, oscillator indicators are particularly suitable because they can indicate when the market is oversold, too many sellers, or overbought, too many buyers. 1 RSI, the classic. Scale, 0 to 100. Typically considered oversold below 30 and overbought above 70. Ideal entry, RSI below 30, especially if it drops below 20. But don't enter immediately. Wait for price structure confirmation. 2. Stochastic Oscillator. More sensitive than RSI, suitable for medium time frames, for H or daily. Oversold below 20, overbought above 80. Suitable to pair with support levels/psychological numbers. For example, ETH at $2,000 plus stochastic below 20 equals, check the waves for entry signal. 3. Bollinger Bands. The lower band can signal an extreme discount area, suitable for identifying potential technical rebounds. On-chain indicators. Not just charts, but direct data from the blockchain. This is rarely discussed, yet it's crucial for medium to long-term multiple entries. On-chain indicators analyze actual user and investor behavior directly from the blockchain, not just charts. Some important on-chain tools and metrics that can assist with multiple entries. 1. MVRV ratio, market value to realized value. The ratio between market price and realized price, average purchase price across all wallets. MVRV. 1. Most investors are currently losing money. This suggests the market may be undervalued. The best entry signals typically appear when MVRV is between 0.6 and 0.9. 2. NUPL, net unrealized profit/loss. Measures market sentiment, euphoria or fear. Red or orange, most investors are losing money, potential bottom, attractive entry level. 3. Exchange reserve. The number of coins stored on exchanges. A sharp decline, coins are being withdrawn to personal wallets, potential accumulation, medium-term bullish. 4. SOPR, spent output profit ratio. The ratio of realized transaction profits. SOPR 1, most sellers are losing money, a sign of a potential bottom. How to integrate indicators in multiple entries. So how do we use all of this without getting overwhelmed? Example entry scenario for ETH, current price $2,200. 1. Daily time frame. RSI 28, oversold. Bollinger Bands, candle breaks below the lower band. Stochastic 15, oversold. This is the first signal for entry 1. 2. Price drops to $2,000. RSI 25. Exchange reserve drops significantly. NUPL indicates that most investors are losing money. Entry 2. 3. Price drops again to $1,800. MBRV 0.85. SOPR 1. Technical structure shows old support. Entry 3. 4. Price spikes down to $1,500. Psychological level plus strong demand zone. All on-chain indicators show extreme undervaluation. Entry 4. Final, all-in remaining allocation. With this strategy, you enter based on data, not drama. Regardless of market FUD or excessive bullishness, you can stay calm because you already have a solid framework. Important note, indicators are not perfect compasses. All indicators, both technical and on-chain, are merely tools. They won't provide 100% accurate signals consistently. That's why it's crucial to combine all contexts. Large time frames. Psychological levels. Support/resistance structures. Market sentiment. Volume. Indicators can provide early warnings, but the decision ultimately rests with you as the portfolio pilot. Chapter 3 Conclusion. Use oscillator indicators like RSI and stochastic to detect oversold conditions. Utilize on-chain indicators like MVRV, NUPL, SOPR to determine when the market is undervalued. Combine indicators with psychological levels and technical support for the most optimal entry points. Don't enter because the price is falling. Enter because the data indicates it makes sense. Okay, Chapter 3 is done. Make sure you fully understand it before we move on to the next chapter. If not, you can go back and review it. In the next chapter, we will discuss practical implementation, how to allocate capital and create a reasonable, stable, and stress-free 4-entry strategy. Without further ado, let's continue. Chapter 4. Use 4 entry points, a gradual strategy that keeps you calm. Many novice traders fall into one fatal habit, investing all their capital at once. When the price drops, panic. When the price rises a little, sell immediately, afraid it will drop again. In the end, the portfolio is weak, the mindset is unstable, and the strategy falls apart. That's why multiple entries are the most human way to survive in the crypto world, especially if you can't monitor charts every day, have a main job besides trading, want to invest in the medium term without stress. The main purpose of multiple entries: reduce psychological pressure, get the best average price, average cost, allow flexibility when the market doesn't meet expectations, participate in accumulation even when the market is down. Why 4 entries? Why not 2, 3, or 5? It's actually up to you. But 4 entries are the sweet spot between. Enough to spread the risk, but not too many to make managing them a hassle. With 4 entries, you can adjust allocations based on confidence levels and technical signals, have a backup if the market suddenly crashes, and enter with a layering strategy at reasonable support levels. Entry structure for layer strategy. For example, you have a total capital of $10,000 to buy one asset, e.g., ETH, SOL, or your favorite token. We divide it into 4 parts. Option 1, fixed amount. Entry 1, $2,500. Entry 2, $2,500. Entry 3, $250,000. Entry 4, $250,000. Suitable for markets you believe will be sideways or slowly rising. Option 2, weighted down entry. Entry 1, $200,000, current price. Entry 2, 2,500,000 Indonesian rupiah, down 10 to 15%. Entry 3, 2,500,000 Indonesian rupiah, down 20 to 25%. Entry 4, 3 million Indonesian rupiah, extreme drop of 30 to 40%. Suitable for bearish markets, but you believe the project is strong. Provides a lower average price if the price continues to fall. Option 3, based on strong support. Determine entry points at technical and psychological levels. Entry 1, current price, e.g., BTC $68,000. Entry 2, psychological level, $65,000. Entry 3, strong support level, $61,000. Entry 4, crash support zone, $58,000. Suitable for those who believe in buying the dip, but still use data, not emotions. Practical example, ETHFI, for example. Suppose you want to buy ETHFI with an allocation of $800. Entry 1, $200, when the price is $2.10, based on RSI indicators and sideways structure. Entry 2, $200, if it drops to $1.90, near support plus psychological level. Entry 3, $200, at $1.70, previous strong support. Entry 4, $200, at $1.50, panic selling zone / discount area. If the price doesn't reach $1.50, no problem. The reserve funds can be used for other coins, used for averaging up if the trend reverses upward, or secured as stable coins. The core of this strategy, you stay calm in all conditions. Mindset. Entry isn't a one-time deal. Many people enter the market like they're entering a shop. Hey, buy ETH now, how much will I get? But entry isn't like buying fried snacks. This is an investment. It requires artistry and patience. With multiple entries, you're not afraid of price drops because you're ready to enter again. You don't FOMO because you already have a plan. You can rebalance your portfolio more flexibly. Use alerts, notifications, and limit orders. This strategy works best when you use alerts on TradingView to know when the price hits the entry zone. Limit orders on the exchange. You can sleep, and the entry will still run automatically according to the plan. 4 entry strategy checklist. Step completed. Determine total capital. Divide into 4 entries. Determine entry levels based on support / indicators. Set alerts and limit orders. Mentally prepared if only 2 entries are triggered. Don't panic if prices drop. Don't FOMO if prices rise. If all the above checklist items are complete, congratulations. You are now an official user of the multiple entry strategy, disciplined and ready to harvest the best average prices. Pro tips. Avoid entries based on rumors or Twitter FOMO. Don't immediately go all in at the first price that seems cheap. Always review your strategy weekly. Use an entry journal. Record the date, price, reason for entry, and sentiment at the time. There you go. Now you know how to manage multiple entries neatly, logically, and with minimal stress. Build habits, not just strategies. So, after talking at length about the multiple entry strategy, from looking at the big picture using large time frames, reading psychological numbers on charts, utilizing technical indicators, to dividing entries into 4 parts that make your head feel calm, there is one important thing you must remember. Strategy is only 20%, the rest is mindset and discipline. Without discipline, even the coolest strategy is just theory that passes by. In the fast-paced, emotional, and FOMO-filled world of crypto, a strategy like multiple entry can be your foundation for staying sane. You don't have to be a technical analysis genius. You don't have to stare at the charts every second, and most importantly, you don't have to follow influencers who might not even know what they're talking about. Create a strategy, write a plan, enter gradually, and leave the rest to the market. You don't need to win every entry. You just need to win on average. And the multiple entry strategy helps you win on average. Before we wrap up, if you like the style of this podcast, educational, no drama, to the point but still easy on the ears, help this channel grow. Subscribe to Mr. So Crypto. Share with friends who need a sound strategy. And leave a comment. What entry strategy do you use most often? I read all the comments, and they really help me decide on topics for the next episode. 5 Rules of MR. SUW Crypto. fresh version. 1. Don't go all in at once. Split your entries. The average price is more important than being exactly right. 2. Don't trust influencers without doing your own research. DYLR, bro. Your money, your responsibility. 3. Don't buy coins you don't understand. If you don't understand the project, you're just buying speculation, not investing. 4. Don't forget to take profits. The main goal of trading is to lock in profits, not to become a die-hard fan of a particular coin. 5. Don't skip journaling. Record all your decisions. It's a mirror for self-reflection and improvement. See you in the next episode. Thank you for listening to this educational episode with Mr. So Crypto. What will we discuss in the next episode? Feel free to write your suggestions in the comments section, bro. Stay safe, stay sharp, and always remember, the market may rise and fall, but logic and plans must remain in place. See you again in the next episode. Peace out, and keep stacking those entries, so fam.